Good afternoon, everyone, and welcome to the RealNex webinar series, our quarterly market update with Dr. Jeffrey Fisher. I'm Jeff Finn, CEO at RealNex, and we're delighted to have you back with us again and to hear from Dr. Fisher in what is a very interesting time in the commercial real estate industry as we head into 2023. And for the past few years, those of you who have been watching have just watched a repeat after repeat where we were hitting record after record, lower cap rates, higher prices, all indexes and metrics going in the same direction. But I think we've got a little bit of a different story this time that we're anxious to hear Dr. Fisher discuss. As I hope you're aware, Dr. Fisher is the head of data and research for RealNex, but also a past professor emeritus of real estate at Indiana University's Kelley School of Business, and literally wrote the book on property finance. He's a co-author of Real Estate Finance and Investments and Income Property Valuation. So well suited as also managing these data services and providing insights for as president of Homer Hoyt Institute and NCREIF. He is working with the institutional investment community to track markets and property conditions around the country, and has fresh, timely data to share, and anxious to hear about that, Jeff. Before we get started, though, just wanted to also let you know that RealNex has come up with a great new solution for the industry on top of our RealNex Navigator, which has an incredibly powerful CRM, financial investment analysis, presentation, and marketing engine. We now have RealNex Navigator Pro, which also includes the base level property information on markets across the country, including land and building information, property ownership, transaction histories, tenancies, and loan profiles with lender rates and maturity dates. So a great new data set to power your RealNex system, working end to end throughout the Navigator solution, with a number of enhanced best practices and predictive analytics to identify likely sales and business development opportunities. So if you haven't checked out RealNex Navigator Pro, call one of your sales representatives or reach out to us and we would be glad to give you a demo. So Jeff, with that, let you take it away and let us hear about the latest findings from your research.
Okay, thanks, Jeff. And I assume you can see my screen okay?
You got it. Yep.
All right. We're going to do a commercial real estate market update. Usual disclaimer. Anything that I say is certainly not a reflection of any views of RealNex and should not be relied on for investment decisions. So, unfortunately, we've got negative returns for the first time since the financial crisis. If we look at data from the National Council of Real Estate Investment Fiduciaries, which is an organization that I work with of institutional investors, the Morgan Stanleys and JP Morgans and Invescos, Prudential Real Estate, and also the plan sponsors like CalPERS and CalSTRS and others that contribute data on the performance of their properties. The data is submitted on a quarterly basis that allows us to calculate returns every quarter in addition to other trends that I'll talk about. And so you can see that returns turn negative. These are unlevered returns. So clearly, if there was leverage on the properties, the returns would even be more negative. And actually, when I was doing the webinar for the NCREIF organization, it was pointed out by one of my co-presenters that it would look even worse if we took into consideration what the real returns would look like. These are nominal returns, and as everybody knows, inflation has been a lot higher last year or so than it's been in the past. So we didn't have the inflation that we have now during the financial crisis in 2009. So it's likely that that line that we're showing now for the fourth quarter of 2022 might even be as low as what we had during the financial crisis. Hopefully it'll be short-lived like it was during the financial crisis. You notice that V-shaped recovery that we had back then. So it didn't really last that long. After Powell's comments today and the Dow dropping over 500 points, there's talk again that maybe it's not going to be quite as soft a landing as we hope, but hopefully it'll again be a short one. So why did returns turn negative? Because there was a lot more write-downs of properties this quarter. It's actually surprising that, you know, there's always been some properties that are written up. They're in the right property type in the right location, but you know, that's the green portion in this chart. Those properties that were written up, but you can see the number that were written down more than doubled from the write-downs that we had last quarter. So a lot more write-downs of properties. Again, these properties are valued every quarter so that there can be a rate of return. It's a little tougher for appraisers to value the properties when you don't have the transactions that you usually have. There's still transactions happening, but some of those, of course, are distressed sales, and makes life a little bit more difficult for the appraisers. I know some of the appraisers thought that there might even be more of a drop than there was, but you also have a tendency, and we'll see this a little bit in some of the later charts, to not sell commercial real estate when prices are down, especially the institutional investors. They don't usually have to sell, and so they would rather not sell when values are down and wait for markets to recover. If we look at this by property sector, you can see really everything was down except for hotel. Kind of surprising. Hotel, which of course was really hurt during the COVID period, and you know, come back nicely. I think, you know, mainly because we have a lot more travel by individuals, vacations, et cetera, for more willingness to travel. Business travel is still hurting a little bit since we haven't had people return to office space as they have in the past, not using as much office space with people working from home. But hotels had a nice return both last quarter and even higher this quarter. But you can see office had the lowest return. Apartment returns, I guess actually industrial was the next lowest, which is kind of surprising. Industrial, until this fourth quarter of 2022, was the star performer for several years, where it had almost obscene rates of return that were more than we've ever seen in any property type over the history, at least of this database. So maybe industrial is sort of reaching a peak, although I saw an article today that although we think of industrial here as mainly warehouse space, there's more and more of a demand for industrial space to be used for manufacturing because of more companies that now want to rely on products being made in the U.S. and not have the supply disruptions, know that, you know, they can count on getting those products from U.S. manufacturers. If we look at the net operating income growth and rent growth, it's really kind of surprising. The NOI growth, as you see during the third quarter of 2022, in the negative territory, but it's bounced back nicely. You have to be a little careful looking at things on just a quarter by quarter basis. There can be some accounting things that impact the data, and you know, lease buyouts and stuff. But when you're looking at over 10,000 properties, certainly it's fairly reliable statistically to do these quarter by quarter comparisons when we're looking at it for the whole nation and all the properties. So NOI growth, you know, I would say is still at a nice level, you know, 2.5% per year. And then, you know, rent growth also around 2.5% per year. I see this. You should have fixed the scale on that. There's two twos. The second two would be 2.5%. So around 2.5% rent growth. So why did returns fall? Well, you know, we'll see. It has to do, as you might expect, with the rise in interest rates causing a rise in cap rates. But sometimes we sort of differentiate between what's happening in the space market, the market for leasing space, versus what's happening in the capital market. And the you know, the space market looks like it's holding up pretty well, although there's certainly some problems with some different property types, as you're all well aware of. But look at rent growth by property type. You can see retail, you know, over 3% rent growth during the fourth quarter. You know, followed by industrial, which would be mainly warehouse, then office. not too much lower than industrial and even apartment, close to 1.5% rent growth. And also look at NOI growth. So retail had strong NOI growth, followed by apartment and industrial and then office. So again, looks like in terms of NOI holding up so far. Of course, a lot of that has to do with existing leases already in place on these properties. We're not looking at the market rent and changes in market rents from quarter to quarter. We're looking at the actual rent being collected on these properties. So it's a little different from what you might see in some other rent surveys. One of my co-presenters from Berkshire on the last webinar put this chart together using the NCREIF data. When I say NCREIF, that's again National Council of Real Estate Investment Fiduciaries, which I've relied on a lot for this presentation, although I've pulled in some other data sources that you'll see. But they looked at it on a same store basis, which means they're only looking at the exact same properties over each time period, whether it's quarter to quarter or in some of the charts it'll be year over year, which is sometimes a little bit better in gauging what's happening to things like the expenses and the revenue. Otherwise, you could have some differences due to acquisitions and dispositions of properties impacting not so much the change, because it'd be more that it's just a different sample a little bit from period to period. So again, you see same store revenue up, and the expenses is part of the reason that the revenue was up, the NOI was up, because you can see the expenses dropped into the negative territory, which mean they went down, right, for both apartments and retail. And the amount they increased for office was quite a bit less than it was the previous quarter. For industrial, it's about the same as it was last quarter, but at a fairly low level, 2% quarter over quarter change in the expenses. So expenses seem to be under control, although I saw, maybe it was on the news today, talking about the problems with increasing insurance costs. So that's something to keep an eye on. But so far, expenses haven't been hurting the net operating income too much. Here we look at same store net operating income on a quarter over quarter basis for each property sector: apartment, industrial, office, and retail. Kind of the same story we saw before, but next to that is the year over year change. So instead of quarter over quarter, it's year compared to a year ago. And again, you see good revenue growth and good net operating income growth for each of the main sectors that are covered in the stated. There are some other property sectors covered that I'll mention later on. But the main index that's produced by this organization, which uses a benchmark for a lot of the different funds, has these main property types along with some hotels included. In terms of occupancy, you see the occupancy has also been holding up pretty nicely. So that's, of course, is one of the reasons why the net operating income is holding up. The net operating income would be a function of what's happening with rents and also with occupancy, as well as what's happening to the expenses that we talked about. So occupancy holding up pretty well by property type. So I also pulled in, there was a report that I got a hold of just yesterday from CBRE, and I pulled in several exhibits from that report that tie in nicely with the other slides and the theme of the presentation. So this is investor property type preferences and lenders property type preferences. So this is very recent survey data for 2023. A lot of the trends I'm showing, of course, are based on historical data, but this is survey data, so more forward looking. Not my personal opinion, so again, based on the their survey results from CBRE. And you see, it's kind of interesting to look at the comparison for the investors versus the lenders. For example, the lenders still have a preference for lending on industrial properties, maybe based on how well warehouse has done in recent years. Whereas it's still pretty good for the investors, but a lot less, right? 27% preferred the industrial versus 41% for the lenders. So, you know, who's right or who's wrong, but we don't know. But investors maybe have, you know, seen the strong performance of industrial and not sure it can continue at the rate it has. You'll notice there is an investor preference for office, 10%, whereas that doesn't even show up on the lender side. And so they didn't even select office as something they had a preference for. Retail, they have stronger preference for retail than the investors. The investors have a stronger preference for the hotels. Multifamily, about the same, right, for both. So interesting to see what not only the differences are between investors and lenders, but just in general what their preferences are. Multifamily looks like it's the highest, right, for both. No, well, no, you still have industrial higher for the lenders, but for investors, certainly the multifamily has the strongest preference. And I think that's supported by some of the data that we've been looking at, and we'll see. And also, you know, retail and office having the lower preference makes sense given certainly what we've seen in returns in recent years. But we'd like to get your opinion on this. So what property sector, I didn't ask Jeff if he had a chance to code this in so they can vote.
It's there, Jeff. Don't worry.
Okay, so what property sector do you think will perform best, highest total return in 2023? Do you think it's going to be apartments, hotel, that came on strong this last quarter, industrial that was real strong until this last quarter, office, or retail?
Just have some of the final votes coming in, Jeff, and we'll post them. 1 second here.
Yeah, actually, I clicked on, I can see it. So,
All right.
wow, 42% industrial. Oh, 46, it just jumped up. All right, I think it's stabilized. So 46%, almost half, are still going for industrial. Only 8% for apartments. That's surprising. I thought apartments might be more. 29% for retail. That's interesting. Expecting maybe a turnaround in retail. 13% for hotels. Only 4% for office. Very, very interesting. Okay. We'll have to remember what those were, Jeff, and look at it.
I think you look back, you know, one of the interesting things was in the retail, and we've talked about this some, but we haven't generally thought of retail being strong, but there's been so much conversion and demolition of lesser quality space. And it seems like that's boding well for the sector as well. It seems like, and that is what we're heading into on the office side. So it could be that some of the investors are less risk averse than the lenders, and from your data, and they're looking to that from a conversion standpoint as well as the value enhanced by some transformation coming.
Yeah, office being converted into retail, and read an article this morning in DC, a lot of office being converted into apartment. Okay, so what's again causing the values to fall? Well, cap rates are starting to go up. You see that in the blue line here. You see where it went up this last quarter. May not look like a big increase, but percentage-wise, it was a fairly significant increase over what it's been. It doesn't take much of an increase when you're at, you know, cap rates below 4% to have it impact the value. And that's of course because of the rise in interest rates. You can see the red line, what's happened with treasuries, and you know, of course they've gone up even since the end of the fourth quarter, which this is based on. Cap rates tend to track the BAAs fairly closely, but that's kind of diverged over the last several quarters, and you know, wouldn't be surprised if, you know, cap rates don't move up a little bit, and maybe hopefully the BAAs will start to come back down a little bit. Although the Fed reminded us again today that they're going to keep at it on interest rate increases till they get inflation down to 2%, which is on some other survey results I've seen. I don't think I included it. Well, I think it is one of the charts here that probably not going to get down to 2% this year. So speaking of that, inflation expectations. Couldn't remember if I included this chart or not. So you can see the majority think that for 2023 anyway, we're going to have 4% to 5.5% inflation. That's the sort of the what the mode, the highest number. Next highest would be 2.5 to 4%. Only 5% think it's just going to be 1% to 2.5%, which is where the Fed wants us to be. And then 13% say it could be over 5.5%. So little difference, but not much from lenders' expectations for inflation. There's even more there that think we're going to be in the 4 to 5.5% range. Of course, inflation has always been good for commercial real estate, at least when rents are holding up and occupancy is holding up because of the ability to pass through increases in expenses. And although we don't have CPI adjustments typically in leases, and for a long time that we used to have, still because of rising construction costs and just the nature of the expense pass-throughs, et cetera, real estate is typically held up pretty well when there's inflation. And if inflation is higher than expected, the returns tend to be higher than expected, so it helps to offset the rising interest rates and cap rates. If we look at discount rates and cap rates, this comes from Altus that values a lot of the open-end funds that are held by the different NCREIF members. And you can see the discount rates went up this last quarter, as you might expect, along with cap rates going up. The difference between cap rates and discount rates tends to be your expected growth. So we have a difference there of roughly 200 basis points, which is 250 basis points, which is kind of what we saw has been the NOI growth. So that all ties in. In other words, you're willing to buy a property at a lower cap rate because you expect your NOI growth and value growth to give you a higher rate of return, which is reflected in the discount rate that investors want. So for institutional property, investors are buying right now at around a 6.5% unlevered discount rate. Of course, it'd be higher than that if you're looking at an equity discount rate, or if you're looking at less institutional grade types of properties. And then cap rates, actually almost the same as we saw in the NCREIF data, even though this is a little different source of data. This is implied by the values being reported on the properties and more of a forward-looking net operating income that would be in like an Argus file. So this data would be taking the Argus files that are used to value a lot of the properties and saying, what was my projected income for the next year divided by the value that I've derived on the property, which may be including other valuation approaches, but that implied discount rate right now is around 4%, up from, what about 3.75% a quarter ago. So fairly significant increase in the cap rate and discount rate. And then what I looked at also was the spread between the terminal cap rate and the going in cap rate. As most of you probably know, that when you're doing a discounted cash flow analysis, the terminal cap rate is what you use to estimate the resale price. So it'd be like, I think I'm going to sell the property 10 years from now. What cap rate would I apply to that net operating income? And then you discount that along with your net operating income back to get the value today, which implies you're going in cap rate. But the point I wanted to make here is that one of the reasons that values are falling is there's an increase in the spread in the terminal cap rate over the going in cap rate. In other words, you're adding more of a risk premium, or I don't know that people would be thinking interest rates are going to be higher 10 years from now, which is kind of a typical holding period. I think it's more of an uncertainty about what that future net operating income is going to be, just less predictable today than it was several years ago. So appraisers are using higher terminal cap rates as well as higher going in cap rates. And the combination of the two is resulting in lower values. And then this breaks down the return into how much of the return each quarter is based on that cap rate change. Is it going up or is it going down? So you see that's the yellow here, or gold, whatever. And that being negative means that's what's pulling returns down. So the cap rate increases is, you can see the major reason why returns have fallen. It's not been the NOI growth. As we saw in the earlier slides, NOI growth has been fine, right? So we see the gray bar there. The NOI growth would have resulted in a higher rate of return. That's being offset, more than offset, by the cap rate change. A little sliver of CapEx in there, then we have the NOI yield, which is the based on the income return we're getting on the property. So income return holding up nicely, and then growth in income, growth in your NOI holding up. It's the cap rate change. You can see that's a lot different from what we had. If you go back to the first quarter of 2022, and then going back to first quarter 2021, you can see cap rates were dropping and helping the return quite a bit. So that peaked out in the fourth quarter of 2021, when we had everything working for us, right? Of course, CapEx is always going to be a little bit negative, but we had the NOI yield, we had the NOI growth, we had the cap rates dropping, and so everything looked good, right? But hopefully that won't last too long with the cap rates rising and pulling down our returns and our values. But if we go back to that survey data and say, what are lenders most likely to modify in their underwriting assumptions as they underwrite properties in 2023, you can see cap rates, is sort of the major thing that's gonna change, and we know the direction is probably going to change, right? Exit strategies, I guess I would interpret that as, like we talked about, what's the exit cap rate going to be? So you got kind of a double whammy there. And then debt yield is going to be more because of that's your interest rate divided by your, I think they divide the interest rate by the whole property value when they use the term debt yield. So the interest is being paid, but divided by the entire property value, not just by the mortgage amount. Then you see the other ones, a little concern about occupancy, taxes, insurance, payroll, and so forth. Interesting, there's not much concern about the rent growth, which maybe because we saw the rent growth has been pretty good. And debt coverage ratio, interestingly, is kind of at the bottom. I would have thought debt coverage ratio might be more of a concern. Okay, and then this was put together by a co-presenter that I had on the last webinar from Berkshire, which looked in more detail across each sector for the major markets around the country. These are the markets where the institutional investors tend to have their capital. So kind of some interesting things pop up here. South Florida markets have generally outperformed, except for Miami retail. Just a lot of movement to Florida. Of course, that's been happening for years, even though the governor would have to take credit for it. Kind of a trend that started quite a few years ago. Columbus was a strong performer for industrial and apartments, but not for office. San Diego, Charlotte, Orlando, Durham outperformed across all the sectors. Los Angeles was one of the strongest performers for industrial, But near the bottom for apartments and office, a real divergence there across the different sectors. New York, Chicago, DC, Boston, San Francisco were among the bottom performers in most of the sectors. Good charts to maybe go back and review later. We'll make the slides available. And then get back to the survey data from CBRE, which ties in fairly nicely with the last chart, although there's some divergences here and not as many markets covered, but Miami, most preferred by both the lenders and the investors. So that is consistent with what we saw in the previous slide. Now, the previous slide was returns, where they performed in terms of returns over the last year, whereas now we're looking more at what they prefer for 2023. So a little different perspective, but you notice here that the lenders prefer New York City, whereas, we saw in terms of returns and certain things I've been reading about office space, it's been kind of negative for New York City. So I'm not sure why investors didn't pick New York City. Right, if we look at the investor list, it doesn't show up at all, whereas it shows up, although not the top one, but it does show up on the lender list. So lenders like New York City, but not necessarily investors. I don't know if I have a good story for that. Do you, Jeff? Well, don't put you on the spot there. So
No, I think it just goes back to that risk aversion. The different profile. New York is seems like quality assets, even though it's going through transformation. The lenders,
yeah,
always safe. It's a liquid market and will always trade. All investors might be waiting for a better day to come in.
Yeah. NCREIF does follow other sectors besides those main ones that we talked about. So just give you an idea of what's happening with student housing, self-storage, medical office, and senior housing. At some point, these will probably be part of the main index because more and more institutional investors are investing in these sectors. They're even in what they call core funds, which are the lowest risk funds, because they provide nice diversification. Of course, they're, as expected, all down this quarter, as was the whole market, and not just the real estate market, but stock market as well. Although we did have a nice recovery until recently here, but you can see actually the returns weren't as negative, especially for student housing and self-storage as it was for the other property sectors. Even senior housing didn't drop as much. So, what's not shown here, that data is starting to be collected on, is rental housing, because that's also been of strong interest among institutional investors, and more and more properties, of course, are being built for rent. Transaction volume is down, and that usually happens when there's a weaker market. And as I indicated before, people tend to take properties off the market and not sell, at least the institutional investors, when returns are down. They don't have to sell. So we prefer to see a higher level of transaction volume. And then again, ties in nicely with the survey, where investors are asked, their expectations for selling. And you can see that the majority say they're going to sell less in 2023. About 25%, a little bit more, say about the same, but only 13% maybe say that they're gonna sell more in 2023. So even though markets are weaker, that's not leading to more sales. That's leading to less transactions. And then expectations for investors contrasted with lenders, kind of the same idea. Pretty much agree in terms of less activity. This was put together by a co-presenter of the last webinar I did at Hines that looked at, again, using the NCREIF data, but he drilled into the performance of office properties that were either less than 10 years old or more than 10 years old. And thought that was kind of interesting that it's really the newer office properties, maybe not a surprise, but the newer office properties that are really outperforming to a large extent the older office properties. You can see pretty big difference in the performance there. Is we look at around a 12% return for the newer, right, versus maybe a 5% return for the older. And then if you look at the rents, you can see that the rental growth is it's looked at on an index basis here, how it's grown. So that you see the rent growth was a lot stronger for the newer properties less than 10 years old than it was for the older properties. And if you accumulate it, so you got cumulative office rent growth by age over that time period, you can see how much the newer properties had much higher rent growth than the older properties. But if you look at the cap rates, there's really not much of a difference between the two. And I guess as I think about it, that kind of makes sense, because if the rent is lower and the value is lower, then your cap rate is going to be about the same, right? You've taken into consideration the lower value by having a lower rent. So although I guess given the outperformance of the newer, I guess I'd expect a little bit more of a divergence here. Where if you expect that to continue, you might be willing to buy the newer ones at a lower cap rate. It looks like it's just the opposite here. You got the older ones at a little bit lower cap rate. So, but maybe not really a statistically significant difference in the cap rates between the two. So where will real estate values be by the end of 2023 compared to now? We think values will be somewhat lower by the end of 2023. Do you think they're going to kind of stabilize at the current level? We've already had a maybe 2.5%, 3% drop in values. Or do you think values will be somewhat higher by the end of 2023? Or you admit that you have no idea? After the NCREIF members, or if you had no idea. And results are coming in. They're still coming in. Whoa. It is pretty consistent with what the NCREIF members thought. 60% values are going to be somewhat lower. Wow. 25% values will stabilize, 5% that they'll be higher. So we have 5% that are optimistic, 10% that have no idea. So 60% that they'll be lower. I guess I'm not surprised. The appraisers keep telling me that they think values have fallen more than we're really seeing in how the investors have written down the properties. Those that are not necessarily writing them down as much as the appraisers would like to see them be written down. Maybe we should ask a question on the extent of the value drop. So even though it's 60% that it's going to be somewhat lower, hopefully it's not like 10% lower, but I guess we'll see as we move through the quarter. All right, so summary. Largest negative return since the financial crisis, and maybe even worse during the financial crisis if we look at it in real terms, deducting inflation from the return. Hotels were the only positive return sector. Rents and NOI growth have been holding up, but if they don't continue to hold up and cap rates still go up a little bit, that's certainly going to be the reason why I guess 60% think that the values are going to still fall. And as the Fed pushes those interest rates up and pushes down the stock market along with real estate values. So we got a little bit of time for some questions, which hopefully, if I can't answer, Jeff can answer.
Appreciate that, Jeff. Yeah, we are open for questions. One of the questions we always receive is, will this presentation be recorded and shared? And yes, and as Jeff said, we'll also share the deck, so you'll have access to the charts and graphs as well as the recording to review and share with your colleagues. I think, you know, one of the interesting issues that we're dealing with today, different than in the past, is that there's fundamental strength in supply and demand in most sectors except office, where there's a major transformation going on. But what are you seeing, or what are you hearing from your and the investor research that you've done on the multifamily and residential in particular? It seemed like we were 3 to 4 million units short, and so there's still a supply shortage even with so much being built. Are we with this wave of development, are we still going to be in a undersupplied situation, or are we going to begin to?
I think we will be. Studies that I've seen, it's been a while since I looked at them, but I looked at it over even a longer period basis, show that there's going to be a shortage for quite a few years. Even though there's a lot being built and more and more being built for rent, I'm pretty optimistic about the multifamily sector. I think it's going to continue to do well once we get through the current time period.
You mentioned the build to rent, and I think that's one of the new financial sources that came out of the great financial crisis, where it took a while to be built, but the banks felt the brunt of the crisis in the lending market, where home equity had evaporated and everything came back to the banks and through the cycle. Now we have tremendous amounts of equity in residential, so it doesn't seem like a banking burden there, and there's a new source of capital that is the own for rent, if it's not built for rent, that underpins. So it seems like residential and multifamily are becoming more homogeneous in its composition, but office might be where the problem is, as loans come due and rents aren't there to support it, if at least in the B class space. So are you seeing any pressure yet in markets to look at what's the level of distress in the market that you're seeing?
I haven't heard a lot of concerns about distress, although certainly in cities like New York, right, we're hearing that people just aren't returning to work. And I talked to some appraisers around the country, they're pointing the same thing, in several cities where people just aren't returning to work, or if they do, it's maybe 3 days a week, right? So and I don't think we know how things are going to sort out for office space yet. I think it's like you said, the other sectors I think are going to be okay. We have a little bit more certainty around what's going to happen with the multifamily, and retail seems to be recovering. You were talking about the build to rent, and it seems that what's happening there is you've got a lot of operators now that are very, very sophisticated in how they build these properties and make it easy to maintain them, and even have entrances just for the maintenance people to get in and fix stuff and standardize all the equipment. And so the institutional investors are really become interested in investing through good operators in the single family rental. So I think that's going to be even added to the NCREIF index over the next year or so.
I guess there's a positive and a negative to this question that's come in. With inflation at the levels that it's been, and the ability to adjust or not adjust given lease structures, do you think that's part of the story in hotels, where they were benefiting from the ability to change rates daily? And with the longer, over time, have you seen a difference in pricing for the short lease of a one-day hotel to the long lease of a 10-year or 20-year industrial or office space? Are they pricing the lease in that way relative to the bond? And
Yeah,
maybe just look at a second question. Is that going to change? Is office going to start looking more like a hotel?
Yeah, that's what I've been reading, that there's more and more desire to have short-term leases and just a lot of flexibility, in the lease term. So it's becoming more of a commodity, right, than it was in the past.
Yeah, certainly becoming more of a service, where there's going to be a lot more given than just space, where there's more sense of community and a way to collaborate and dynamic interaction for social engagement, not just to sit at your desk and do work. Next question on what's your view on unemployment projections and the result of the change in employment on various sectors?
That's kind of out of my expertise.
You're not the economist. You're the
afraid not.
Financial investment analysis.
But it does sound like, in terms of Powell's testimony today, I know he got grilled by, one of the congressmen that, how many people are going to be put out of work because of the rise in interest rates, and what if they were asking Powell what he was going to tell all these people that were going to become unemployed, and of course his answer was, well, it's where our focus is on making sure they don't have to pay higher prices for stuff, but it certainly sounds like there's going to be a result of the rising interest rate is going to lead to more unemployment. In terms of what level that gets to, I guess I haven't really looked at that, but I don't see how, at least the opinion of the congressman drilling Powell was that unemployment, and he didn't disagree that unemployment wasn't going to go up. Just that he was trying to avoid saying that was bad, as opposed to keeping inflation under control.
Still seeing shortages in many areas where people can't find the people to work. So it just depends on the role in the market that you're in.
Right. So we're talking about unemployment problems, and yet I keep hearing companies say they can't hire people.
Right. And so we still have some time. If there are other questions, like we've exhausted those that have come in. Give you another minute for some thoughts to share, or even perspectives. If some of you have a perspective that you'd like to input and share with the group, we'd love to hear from you. Well, it sounds like you've answered the questions in advance, Jeff. As always, well done. We really appreciate your time and the amount of information that you've been able to distill and share in a short period of time. Sorry, it's not as good news as it's been over the past few years, but it's important news and important information for the group to understand and begin to work with their clients or with their funds to manage and look at how they want to invest or hold and make their investment decisions. So we will look for everyone coming back for our future sessions of this. Jeff, we do appreciate your sharing your insights with us. And as always, if any of you have more interest, please send any questions in, and we can answer them at various times throughout the cycle. And if you're interested in taking a deeper dive look at RealNex and how it can help you in your investment decision making and analysis, we're glad to show you how we have tools that can help you in that case as well. So appreciate all your time and hope you all have a wonderful afternoon, and look forward to seeing you next time.
Thank you, Jeff.